Hi everyone. Your money is in the bank. You've been putting it there for decades, and you assume that when you need it, you can get it. That is the entire purpose of a bank. But right now in 2026, that assumption has some real cracks in it. People are walking into branches asking for their cash and being told no, or being asked why they need it, or having their account locked while the bank checks whether they're being scammed, without their permission, without notice, and sometimes for weeks. There are rules in place, some brand new this year, some that most people have never heard of, that give your bank the legal authority to block your access to your own money. Not because you did anything wrong, not because the bank is in trouble, but because an algorithm or a teller decided your transaction looked suspicious. Today, I'm walking through 4 of those rules. What sets them off and exactly what you need to do to protect yourself before it happens to you. Before we get into it, subscribe to this channel right now and turn on the bell. The banking rules affecting seniors are changing faster than most people realize, and when they change, your bank does not send a personal explanation. I cover these changes in plain English, so you find out before you're standing at a teller window wondering why you can't access your own account. Subscribe now and let's get into it. The first thing you need to understand is a federal rule called FINRA Rule 2165. And if you are 65 or older with a brokerage account, a retirement account, or any investment account, this rule applies to you specifically. It gives your financial institution the legal authority to place a temporary hold on any transaction from your account if the firm believes, even just suspects, that you may be a victim of financial exploitation. They don't need proof. They need a reasonable belief. What does this look like in practice? You call your broker to move $15,000 from your IRA into your checking account because you're buying a car. The transaction gets flagged. The firm puts a hold on it while they review. You can't access the money. The initial hold can last up to 15 business days, 3 full calendar weeks, and can be extended further if the investigation remains unresolved. This is not a computer glitch. This is the rule working exactly as intended. And in January 2026, the situation got significantly more aggressive. Over half of all U.S. states have now enacted or strengthened what are called safe harbor laws, legislation that explicitly encourages banks and brokerages to delay transactions they deem suspicious and protects those institutions from being sued for doing so. That legal immunity has changed the calculus significantly. When a bank could be sued for freezing a legitimate transaction, they were more cautious about pulling the trigger. Now that they're protected, the automated systems and the tellers are far more willing to intervene first and ask questions later. The transactions most likely to trigger a freeze are large, one-time withdrawals that don't match your usual pattern. Transfers to people who aren't already in your payment history. Requests to send money to new accounts or new recipients, and any transaction accompanied by behavior that seems anxious or pressured, because the teller may be trained to interpret that as a sign of exploitation. What you can do before any large or unusual transaction: call your bank and tell them it's coming. A simple phone call. I'm planning to withdraw $12,000 next week to buy a car from a private seller. Creates a record that the transaction is expected and intentional. It dramatically reduces the chance of a freeze. You should also set up what's called a trusted contact on your account, a family member the bank can reach to quickly verify your safety. Because one of the main reasons freezes get extended is that the bank can't verify in time. The trusted contact has no access to your money. They're just someone the bank can call. The second situation is one that most people walk into completely unknowingly, and it can result in your account being frozen, your money seized, and a federal inquiry. All from a perfectly innocent habit. It's called structuring, and it's a federal offense under the Bank Secrecy Act. Here's the background. Banks are required by law to file a currency transaction report with the federal government for any cash transaction, deposit, or withdrawal of $10,000 or more. Most people know this at some level. What they don't know is what happens when you try to avoid triggering that report by keeping your transactions just under the threshold, withdrawing $9,500 instead of $10,000. making three $3,000 deposits instead of one $9,000 deposit. Breaking up a large transaction into smaller ones specifically to stay under the reporting limit is a federal crime called structuring, regardless of whether the money is completely legitimate. The IRS and the Department of Justice have pursued structuring cases against seniors who had no idea what they were doing was illegal. A retiree in Michigan who regularly withdrew $8,000 from her savings, money she had earned and saved over her lifetime, had her accounts frozen and $35,000 seized through civil asset forfeiture. She was never charged with a crime. She simply had a pattern of withdrawals that the algorithm flagged. It took over a year of legal fighting to get the money back. The rule is simple, and it will protect you. If you need to make a large cash transaction, just make it the full amount at one time. Yes, the bank will file a currency transaction report. That is fine. That is normal. That report does not mean you are in trouble. It means the bank followed the law. What gets you in trouble is breaking a large transaction into pieces to avoid it. Don't do that, even if it feels like it would be simpler or more private. The third situation is something many seniors are discovering when they walk into a branch they've used for years and find the experience completely changed. Major banks Chase, Bank of America, Wells Fargo have been converting branches to what they call cash-light or appointment-required formats, particularly in areas where the demographics skew younger and mobile banking is dominant. In these locations, large cash withdrawals are not available on a walk-in basis. If you need more than $3,000 to $5,000 in cash, you may be told to schedule an appointment several days in advance or to take a cashier's check instead. This is not inherently illegal. Banks have always had the right to manage their cash inventory. But for seniors who rely on cash, who are not comfortable with cashier's checks, or who need money quickly for an urgent situation, this can be a genuine problem. ATM daily withdrawal limits, typically $500 to $1,000 per day, don't help if you need $4,000 in the next 24 hours. What you can do. Know what your branch's cash policies are before you need cash urgently. Call and ask whether they require advanced notice for withdrawals above a certain amount. If you regularly use cash for larger expenses, establish the habit of planning those withdrawals a few days ahead and maintain accounts at more than one institution, a backup bank or credit union, so that if one location can't meet your needs, you have an alternative. The fourth situation is one that catches seniors with perfectly normal financial habits entirely by surprise. If you have a savings account, or any account that you don't touch frequently, your bank's automated systems may be in the process of classifying it as dormant, and the consequences of that classification can be severe. Under most state laws, if a bank account shows no activity for a period of between 1 and 3 years, the institution is required to transfer the funds to the state treasurer as unclaimed property. In many banks in 2026, the definition of activity has narrowed significantly. Automatic transactions like interest being deposited or automatic dividend payments may no longer count as activity under the new rules. Only a transaction you initiate manually qualifies as keeping the account active. What this means practically: if you have an emergency fund or a savings account you keep as a safety net and never touch, that account may be approaching dormancy without you realizing it. The first sign many seniors have is trying to access the account and finding it frozen or receiving a notice that the funds have already been transferred to the state. Getting money back from the state unclaimed property process takes time, requires paperwork, and is available, but it is not fast when you need the money now. The fix is simple. Log into each of your accounts at least once a year and make at least one manual transaction. A small transfer in or out, a manual check of the balance, anything that registers as intentional activity once per year per account is enough to keep it alive in the bank system. So, here is the full picture. FINRA Rule 2165 and the new safe harbor laws in over half of U.S. states now allow banks to freeze your transactions for up to 3 weeks if they suspect exploitation. And the best defense is giving your bank advanced notice of unusual transactions and setting up a trusted contact. Structuring. Breaking large cash transactions into smaller ones to stay under the $10,000 reporting threshold is a federal crime, even when the money is completely legitimate, and the consequence can be civil forfeiture. Branches are increasingly limiting cash availability and requiring advance appointments. So, plan large cash withdrawals ahead of time and maintain a backup banking relationship. And inactive accounts can be transferred to the state as unclaimed property, even if you fully intend to use them. One manual transaction per year per account keeps the clock reset. Subscribe. Share this with someone who uses cash regularly or who has accounts they don't touch often. And I'll see you in the next.